Hello everyone. We often hear about the titans of finance, the Rakesh Jhunjhunwalas, the Warren Buffetts, who built immense wealth in the stock market. But what about the other side of the coin? What about those brilliant minds, those intellectual giants who, despite their astounding intelligence, lost fortunes in the unpredictable world of shares? Today, we are diving into the fascinating stories of two such figures, arguably the sharpest minds ever, uncover their mistakes, and learn invaluable lessons for our own investment journeys. Before moving on, please read the entire disclaimer carefully. So, the first genius which we are going to talk about is Sir Isaac Newton. Isaac Newton does not need any introduction. We all must have heard or read about his name at some point in our life. He was an English mathematician, physicist, and astronomer who is considered one of the most influential scientists of all time. He is best known for formulating the laws of motion, one of which is every action has equal and opposite reaction, and the law of universal gravitation. You must have heard about an apple falling on the head of a scientist. So that was Isaac Newton. But today, we are not talking about his success, but rather his failure. This story is going to prove that not only general public but also the sharpest minds could lose money in the share market. In 1711, a British joint stock company was created known as the South Sea Company in order to consolidate and reduce the country's national debt. As part of a public private partnership, the government gave the company a monopoly on trade with South America and the South Seas in exchange for it buying up the national debt. This led to a period of intense speculation known as the South Sea Bubble, where the company's share price skyrocketed from around 128 pounds. So pounds is the currency of England. So around 128 pound in the January of 1720 to nearly 1000 pounds by June. So from 128 to 1000 in just 6 months. Newton initially invested and being a sharp observer even made a hefty profit by selling his shares early on. He initially sold his shares for a substantial profit of about 7,000 pounds. At the moment, pound is around 100 rupees. 1 pound is about 100 rupees. And we're talking about 7,000 pounds in 1720. So more than 300 years back. He saw the speculative nature of the rise. But here is where the genius stumbled. As the bubble continued to inflate and everyone around him seemed to be getting rich, Newton could not resist. He succumbed to FOMO, the fear of missing out. He reinvested a substantial portion of his wealth close to the peak of the bubble, only to see it burst spectacularly. When the bubble inevitably burst in September of 1720, the stock price plummeted and Newton lost a fortune. His total losses are estimated to have been around 20,000 pounds more than 300 years back, a modern equivalent of several millions. His initial logical decision was overridden by emotions, contagion, and the desire to join the easy money parade. This event is said to have been so painful for him that he forbade anyone from speaking the word South Sea in his presence. His famous quote, I can calculate the motions of the heavenly bodies, but not the madness of people, is widely attributed to his experience with the South Sea bubble. So, what are the lessons learned from the story of Isaac Newton? First, beware of the madness of crowds. Even the smartest individuals can be swayed by speculative frenzy and herd mentality. Do not let others' perceived success override your own logical analysis. And second, stick to your convictions. If your initial analysis suggests something is overvalued or a bubble, do not get pulled back in by FOMO if it continues to rise irrationally. Okay, now let's move on to the next story. This story is about Albert Einstein. He is another titan of intellect whose name is practically a synonym for genius. Einstein was born in Germany but then later moved to America. He was a theoretical physicist who developed the theory of relativity, a cornerstone of modern physics. He is also famous for his equation E is equals to mc square, which explains the relationship between mass and energy. In 1921, he was awarded the Nobel Prize in Physics for his work on the photoelectric effect. Einstein, like many others, saw the booming American stock market of the 1920s. He invested a significant portion of his Nobel Prize money from 1921 into the stocks. This was a time of widespread optimism, where many believed the stock market was a sure path to wealth. That decade, known as the Roaring Twenties, had been a decade of industrial expansion in the Americas, and much of the profit had been invested in speculation, including in stocks. Many members of the public, disappointed by the low interest rates offered on their bank deposits, committed their relatively small sums to stockbrokers. By 1929, the US economy was showing signs of trouble. The agricultural sector was depressed due to overproduction and falling prices, forcing many farmers into debt, and consumer goods manufacturers also had unsellable output due to low wages and thus low purchasing power. Factory owners cut production and fired staff, reducing the demand even further. Despite these trends, investors continued to buy shares in areas of economy where output was declining and unemployment was increasing. So the purchase price of stocks greatly exceeded their real value. And what happens next? It is what always happens. Then came the great crash of 1929. That was a major stock market crash in the United States of America, which began in the October of 1929 with a sharp decline in prices on the New York Stock Exchange. It triggered a rapid erosion of confidence in the US banking system and marked the beginning of the worldwide Great Depression that lasted for 10 years until 1939, making it the most devastating crash in the America's history. The primary mistake Einstein and many others made was underestimating the non-mathematical behavioral aspects of the market. The market leading up to 1929 was driven by excessive speculation, leverage, and a disconnect from underlying economic realities. When the Great Depression hit, culminating in the infamous 1929 stock market crash, even fundamentally sound companies saw their values decimated due to panic selling and a collapsing economy. Einstein's analytical brilliance in physics did not equip him with the foresight or the emotional detachment needed to navigate such a catastrophic economic downturn driven by human fear and systemic collapse. He was a product of his time, caught in a broader market frenzy. So, what are the lessons that can be learned from the story of Albert Einstein? First is markets are not purely rational. Unlike the laws of physics, stock markets are heavily influenced by human emotions, fear, greed, and macroeconomic events. Pure logic and mathematical prowess are not enough. And second is diversify and understand the risk. Relying too heavily on a single asset class like stocks around a speculative bubble or failing to understand systematic risk can be devastating. Okay, so these are the two stories which show that the stock market is not governed by some logical mathematical principle as physics. It is a complex system influenced by unpredictable human emotions, mass psychology, and external events. A brilliant mind in one field does not necessarily provide an advantage in a completely different one, like financial speculation. So, if you too are losing money in the share market, do not get disheartened. Learn from the mistake of others, educate yourself financially, remain up to date with the share market, and keep in mind these four learnings, along with several others, from the stock market journey of two of the greatest geniuses of all time. First is the beware of the madness of crowds. Second, stick to your convictions. Third, markets are not purely rational. And fourth, diversify and understand risk. So that is all from my side in this video. Thanks for watching this video. Please like, share, comment, and subscribe. I'll be back soon with another video. Goodbye for now.